Okay, we'll start it now. Good afternoon and welcome to another Nathan Trust tax webinar. Today we're going to be dealing with RSUs, restricted stock units, stock options and tax questions in that area. The webinar is in a questions and answer format. We have a number of questions that we've received over the last couple of weeks from our customers, and we'll deal with those. And also there's the opportunity to click on the ask a question in the webinar, and you can just click that button and the question will come through to us and we'll do our best to answer it. On the webinar, I had David Bruton, who heads up our tax team. He's a chartered tax advisor and he deals with the majority of the tax questions we get in this area. Hi, Dave.
Hi, Philip.
Well, let's get right into it. So first one was, I got a 15% discount on my ESPP. Do I need to pay tax on this? I'm guessing by ESPP, that is Employee Share Purchase Program.
Yes, yeah, it would be. So the discount, yes, in all likelihood, I suppose, where you've received something at less than value, in most cases, you would have a taxable benefit effectively from your employer. So yes, the chances are there would be tax to pay on that.
And would the employer have paid that tax on behalf of the PAYE employee, or would they have to do it themselves?
It would depend on the scheme involved. So I suppose you really need to see the nature of the scheme. So it may be that the employer has deducted the tax at source, or possibly not.
How could you? Is that tricky to verify, or is that easy to figure out?
I know it would be relatively straightforward once you see the paperwork involved.
So we just contact the employer, ask them, have they paid the tax in this? And if they haven't, then you have to pay it in your annual tax return.
Exactly. Yep.
And that gets filed as income.
It would be, yeah. It's effectively viewed as income from your employment, from same as the salary you get effectively. That's how we treat it.
And so it would probably be at the higher rate. And was there PRSI and USC and all that sort of bad stuff on it, or good stuff?
There would be, unfortunately, yeah.
Okay. So it's something that you need to be careful with. There could be a reasonably big number there. All right. The next one is, I was issued options in 2020, but have not sold them. Do I still need to file a tax return this year? Guessing maybe their terminology maybe is a little bit mixed up, but they were given the options, but they haven't sold them. They haven't cashed in their chips, I guess. Do they still have a tax liability for this year because it was 2020?
I suppose just to maybe run through the terminology and but not maybe get too bogged down in it. I suppose with share options, you've three events. So you've the grant of the share option, which is where your employer says we're giving you the option to get these shares in future, subject to certain terms and conditions. You've the vesting, which is where all the conditions are met. So the share options might be granted subject to you still being employed in 3 years' time, or profits hitting a certain level, or whatever it might be, whatever conditions. So the share options vest when all the conditions are met, and at that point you can effectively get the shares. So when you get the shares, it's called exercising the share options. So exercising the share options is a taxable event. You're not taxable when you're granted the share options from your employer. You're not taxable when the share options vest and you can exercise them. You're taxable when you actually go and exercise them. So if someone has exercised them in 2021 now, sorry, was it 2020 or 2021?
2020, they were granted them.
Granted, okay.
But they haven't sold them. So by exercised, I guess, and you mean sold?
Not necessarily. So exercise means that you now have the shares. You have full ownership of the shares. They're no longer a share option effectively. So you've a taxable event when you exercise the share options, and the obligation is on the employee there rather than the employer to deal with the tax. So what the employee is supposed to do within 30 days of exercising the share option is file a return with revenue and pay the tax over to them. So the exercise of the share option, you're taxable on the difference between the market value of those shares what you could sell them for straight away, and what you paid for them. That difference is seen as part of your income from your employment. So it's subject, as you said earlier, subject to income tax, USC, PRSI. And what you're supposed to do is pay that tax over to revenue within 30 days. You file a particular form, it's an RTSO, it's called. And then what you're supposed to do is include it in your income tax return for that year. So let's say if they exercise them in 2020, you'd now be filing your 2020 tax return by 31 October this year.
And they probably should have done an RTSO and paid over the money.
Yes.
In the case where they haven't done it,
I suppose I would look to maybe figure out how much you should pay and try and pay it over to revenue sooner rather than later, because strictly speaking, the tax is overdue. So you could have interest on late payment there. So it would be worth dealing with it sooner rather than later, and include it then in your income tax return as well for 2020.
Okay, and this kind of brings on to another question further down. Does revenue know I have RSUs or stock options?
So with stock options, they've been reported to revenue for some time. So the employer has to file a yearly return with details of share options on it. They file that by, I think it's 31 March, the year following. They've recently brought in reporting requirements for the employer as well for restricted stock units. So I suppose the short answer is yes, revenue get, or at least they should get all of this information from your employer.
Okay, so revenue have it, and they see who received it, when they received it, and how much they received it. So they can easily do the calculation if they so choose. There's a bit of news about this as well. I think recently it was in the Irish Times a couple of weeks ago. So it probably, we don't know for certain, and we're not looking to scare people or anything, but this is something that revenue have all the information for. There's no doubt about that. Is that fair?
I think that's fair to say. And I suppose what revenue quite often do is they'll focus on an area where they think there isn't a high level of compliance, and where there's an underpayment of tax that's reasonably significant, and they'll create a project out of it. And I think it's the particularly share options, but also the RSUs and subsequent CGT on them. To me, it's always been an area that I expect revenue at some point to start focusing on.
Okay. Okay, there's a double question here. If I sold shares in July 2021, is it October 2022 when I submitted CGT, or is this October 2021? So he sold shares in July 2021, and when did he submit his CGT? I think he might be mixing up his CGT return with his annual tax return.
So I suppose, yeah, you've two different obligations. So they were sold in July 20.
July 21.
You said July 2021, Philip, was it?
Yes.
Or July 2020. 21, sorry. 21. Okay, so you've a deadline for paying the CGT on the disposal. So if there's a CGT liability you sold in July 2021, that should be paid by 15 December 2021. So if you have a disposal that happens between 1 January and 30th of November in a year, you pay the tax to revenue on the 15th of December. But all you're doing at that point is just paying the tax liability. What you would do then is you would include that in your CGT return for all of 2021, and that should be filed by 31 October the following year, 31 October 2022 in this case. So you've two different requirements: pay the tax later this year and file the tax return by next year.
Okay, and so is it, just so clear, next year, is it a tax return or is it a CGT return?
So it can just be a CGT return. If you're not obliged to file a full income tax return, you can just file details of the CGT return with revenue. You don't have to go and file a full income tax return. Okay.
All right. And the follow-up then for this is the calculation for CGT. Now, there's a bit in this, so just bear with me. Say when a share vests at $10 and the sale price is $20, so the profit in terms of CGT is $10, or is it $20? As the company would have adjusted the salary at vest time to purchase the RSU and pay the income tax. So from what this person's heard, the £10 profit is what their tax is, what they need to pay CGT on. Is that correct?
That would be correct. So I think if my understanding of their question is correct, what they're saying is that when they received the share, the market value of the share was $10 a share, and they've held on to it for a period of time, and the value of the shares increased to $20. So if you go back and take the point at which they received the share was valued at $10, and possibly the tax would have been deducted, and they may be got less than $10 worked, might be what's confusing them. But for CGT, it's the value of the shares when you receive them, which is the $10, versus the price you sold them for when you dispose of them, which is the $20. So they're correct. It is the $10 per share CGT gain that they're making there. So
it's kind of it's CGT on the profit when you sell it, and it's income tax on the value when they vest.
Exactly. Yep.
Okay. And that is a question that just popped in there, was there are RSUs taxed twice. There's two tax activities, but they're not really taxed twice as such, are there?
Correct. So I suppose if you took a situation where, let's say, you received shares or through RSUs and they're valued at $10 a share, that'll be subject to income tax at, let's call it 50%. It's roughly 50%. So if you hold on to those shares for a year, and let's just say that the value of the shares didn't change from the $10 a share, when you sell them for $10 a share, you'd have no additional CGT to pay. You'd still have a filing requirement to return it to revenue, but you'd have no additional tax to pay. So it is taxed twice, but not on the same profit or gain. It's only if you make a subsequent gain that a CGT liability would come into play.
Okay, perfect. There's one here, get this quite a bit. So I'm a non-dom. Is it true that I can avoid paying CGT on my RSUs? So I guess just to introduce the concept of the non-dom, which is, as a rule, it's someone who's born and educated outside Ireland, but is currently tax resident in Ireland.
That's correct. Exactly. So it's the general rule of thumb is, let's say if you were born outside of Ireland, your family's from outside of Ireland, you grew up outside of Ireland, chances are you're not domiciled in Ireland. It can get a little bit more complicated where you've got people who've had parents from Ireland and maybe grown up abroad, but generally speaking, that would kind of be the rule of thumb. So yes, they can potentially sidestep a CGT liability on the shares. I suppose with the non-domiciled individuals, the way that they're taxed in Ireland is they're taxed on what's called a remittance basis. So for foreign source income and gains, they're only taxed on that in Ireland to the extent that you bring the income or the gains back into Ireland. So what we find with a lot of people who've RSUs and stock options is that the parent company may be based abroad, the US or elsewhere, and when they receive the shares, quite often it's through one of the large US stockbrokers rather than say one of the stockbrokers here in Ireland. So if you've got shares in, let's say, a US tech company, and those shares are held in a brokerage account in the US, it's a US based listed company or based company. When you dispose of those, if you don't bring the proceeds back into an Irish bank account, or you don't spend it in Ireland, you just leave it sit in the US or elsewhere, it's not taxable in Ireland if you're not domiciled in Ireland.
Okay. And then with that money, so if that money sits outside Ireland as a non-dom, not taxable, can they then potentially reinvest that money, use it to make other investments that sit outside Ireland and possibly remain out of the Irish tax net?
They can. So I mean, if they reinvested it and they had another gain on whatever investment they put the money into, that subsequent gain, again, if they don't bring that money into Ireland, it's not taxable in Ireland if they have another gain and they dispose of it, or if they start generating dividend income from it as well. As long it's only at the point where that money comes into Ireland that it would be taxable. Now, there's certain investments where you just have to be a little bit careful, but generally they're funds, things like that. So investments in stocks, they're fine. It's just funds. Sometimes you have to look a little bit closer at it because the rules can be different.
Okay, so there's a big advantage if you're a non-dom and you have RSUs, you can really make it work for you. You can be very tax efficient on it, and all in a very above board way.
Absolutely. I mean, it's perfectly within the rules here in Ireland for for someone who's not domiciled to do that.
Can we change our domiciles?
It's tricky, actually.
Okay. So let's not go into it. Okay, so we usually wrap it up after about 20 minutes, and we're nearly there. That was good questions, good turnout again. So I suppose unless we give people a couple of seconds, no, nothing coming in. So again, thanks for everybody for turning up as ever. Thanks, David, for your time. And we'll put this on our YouTube and send a link to everybody that attended. And we're available for any questions anyway. So thanks again. Have a good day.